So there are a few folks in the media who are still here, and so one of the first things that we'll do is walk through what we call a media toolkit. And in some ways, we probably should have done this at the beginning of the day, where we actually go through and just sort of go through pension basics and some pension math basics. So we'll go through that and go through some terms, and then we're just going to open it up to Q&A and discussion and comments. So if there's a question you have for us, or that wasn't answered earlier, or you weren't able to address earlier, please let us know that. If you just want to make a comment, that's okay as well. And then we'll wrap up whenever we wrap up, but at the latest at 4:30. Okay? All right, so I'm going to go ahead and start with this is the basics of the basics here. And again, as I think in my initial comments this morning, I talked about my reporter friend in Marin who had been covering this issue for 30 years, but still didn't quite understand it very well. And so I want to start with the assumption that some people may not know the differences between defined benefit and defined contribution plans, for example. So a defined benefit plan, obviously typical in the public sector. There's a, in theory, guaranteed benefit based on the years of service, final salary, there's a minimum age typically, and some sort of benefit formula. So an example might be here, 2% at 60, means you get 2% of your final salary, might be the last 1 year, might be the last 3 years, but 2% times that final salary times the number of years of service. So this example was a salary of $50,000, 30 years of service, and that works out to 50,000 times 2 times 20. Sorry, I missed an edit here. It's supposed to be 25 years of service. Anyway, it works out to $25,000. Typically contains a COLA. And the COLA is pretty significant. I mean, we're actually looking at the question of how impactful the COLA is in terms of liabilities long term. And the COLA is substantial. And one of the things that I heard, not today from CalPERS, but in a recent conversation with them, was that they said they were shifting to focus on the liability side. So a lot of the focus, as I said earlier, is that was on the asset side, but they're actually starting to look at the liability side. I think a lot of folks out there are trying to do that. And specifically, if there were a reduction in the COLA from typically 2%, some actually have higher caps. I know Stockton had a 5% COLA. That's not a guaranteed 5%, but up to 5% per year, which is pretty generous. Defined contribution, on the other hand, is what we get here at Stanford, a 403B specifically. It's not predetermined. It depends on the balancing the account at retirement age. The risk is essentially mine, whereas in the previous case, the risk is essentially the employer's. One of the things that you'll see on Pension Tracker is this actuarial versus market basis. And an actuarial basis is essentially what the systems assume. So it assumes, the longevity tables, the rates of return, everything that is baked into that assumption. And on the market basis, on Pension Tracker, we use a market value of assets, as they do on the actuarial side for the most part now. CalPERS does at least. But we discount the future benefit payments using the yield on a 20-year treasury. So when this report that I mentioned, this case study report that I did that has the 14 case studies, actually has actuarial and market basis in addition. And so you can, it'll give you a sense of the differences in the outcomes if you use that market approach as opposed to the quote-unquote actuarial approach. Hopefully everyone knows what a market value of assets here. Again, this is very basic stuff. And I remember one of the first conversations I had with John Chauvin, who used to run CPER. He said, look, what you got is what you got. You ought to count your assets as what your assets are valued in the market as opposed to what you think you're, smoothing them out or whatever. And so some systems have moved over to a market assets valuation. Actuarial value smooths those out to minimize the effects of volatility. The AAL, or actuarial accrued liability, is the present value of fully projected benefits attributable to service credit earned as of the valuation date. And it's typically the entry age normal accrued liability is what CalPERS uses. I won't go into the details of that. Funded ratio is simply market value of assets over actuarial value of assets. And again, on Pension Tracker, we have a market funded ratio and an actuarial funded ratio. So you can see the differences between those as well. The UAAL, or unfunded actuarial accrued liability, we call pension debt on Pension Tracker. And it's because, some actuaries may not like that, but we try to make this a little more vernacular. And so that is called, that's simply the amount of money that you are responsible for which you don't have assets. The discount rate we talked about a lot, assumed rate of return. Again, the big difference between a public sector DB plan and a private sector is in the public sector discounts liabilities using that high discount rate, the assumed rate of return. It's a high-grade corporate bond yield on the private sector side, so you end up with a very different outcome, and by definition, you have a much more conservative and aggressive funding approach on the private sector side. I don't know if anyone ever said risk-free rate here today, but maybe someone said risk-free rate, but a risk-free rate is simply typically a treasury rate, and we assume that to be some year treasury yield for typically, certainly, on the liability side of the Pension Tracker, we use a 20-year, which today, I think I looked this morning, it was, I think, 2.52% for a 20-year treasury. So, a very conservative rate, but also the point is it's one that you can have a lot of confidence in. And I wanted to apply this to Palo Alto. I know there's at least one person still, for a couple of people from Palo Alto, just graphically. So this is the 2016 miscellaneous plan. This is the latest data that just came out a couple weeks ago from CalPERS. On the liability side, you see the 4 parts of this column chart, and these are in millions. So the liabilities for people who have already retired from Palo Alto, $418 million. For active members, it's that other, actually active, and the 2 others, those are terminated and transferred employees. So someone who might have worked, say, 7 years and then quit and didn't stay, or they worked for a few years and they transferred to Mountain View, where they're also a CalPERS annuitant. And the total there is $730 million. On the right-hand side, the assets, this is the market value of assets, $469 million. And the difference between the assets on the right side and the liabilities on the left side is $359 million. The numbers must be rounded here because that doesn't add up. But $359 million, that's the UAAL funded ratio. MVA over the AAL is 64.2%. So Palo Alto's miscellaneous is 64% funded. One of the things I want to point out on this is really interesting, and I didn't really pay a lot of attention to this until about a month and a half ago when I started drawing these charts. Palo Alto has $469 million in assets. That's enough to cover their retired employees, but that's about it. So in other words, they have enough to pay people who have already retired, but they don't have assets to pay people who are working today or for people who have transferred or have terminated along the way. And that always that jumped out at me as really screaming as loudly as you can imagine, there is a huge problem here. I mean, when you have assets that are enough to cover this, but you've got essentially close to zero in the bank for everyone else, that's a problem. So at any rate, again, I just wanted to apply those terms to this graphically. Yes? Yes? Yeah, this is the miscellaneous plan only. It's not safety, and this is on an actuarial basis, not the market basis. So on a market basis, it's about 1.2 billion. So if you use that lower discount rate for liabilities as we do on the market side, it ends up being about 1.2 billion, right? So if you just use the numbers that CalPERS publishes, the actuarial numbers, the safety numbers, I think around, I'm guessing here, it's not maybe, not quite 200, but around 200. So maybe that number here, maybe it's $550 million total on an actuarial basis and about 1.2 billion on a market basis. Right, okay. Yes?
Take in to pay the last investors, but the people that are in the program that are supposed to benefit, there's no money set aside for them.
I mean, I think Governor Brown called this a Ponzi scheme at one point. I've never used that phrase, but I'm just saying that it's not well funded, and the assets are sufficient only to cover the retired employees, the retirees, but not anyone else, not the current.
Alarming.
Sorry?
That's pretty alarming.
I agree. And as someone mentioned earlier this morning, if I think it was David Crane who said, if I were a teacher, the state's got my back. If I were a state employee, the state's got my back. But if I were a local employee, and if I were a local employee in an agency that maybe is not terribly healthy financially, I'd probably be more concerned.
So the question is what to do.
We'll get to that. Well, there are a lot of things. I mean, you heard a little bit a minute ago, about governance reform and so forth. And this is jumping ahead a little bit, but there's a way out of this. It's going to take a long time, but it's also going to take a more realistic approach about, with lowered expectations and so forth. So we can talk about that more in a few minutes. So contribution rates, again, you've heard this through the day, but we've talked about employer contribution rates, employee contribution rates. And as I said, or someone said earlier, the employer contribution rates are set in theory to get to a full funding level. I think it was the gentleman from CalPERS who kept saying, yeah, but if we earn 7%, we'll get there in 30 years, right? And typically there's a 30-year climb out. That's what it is for CalSTRS as well. I mean, CalSTRS is looking at a 30-year climb out. It's a long time to get there. Eventually they will get there if all goes well. The challenge I think a lot of people would raise, the question people would raise is, are things going to go well, or can you count on that going forward? The employees typically set in statute to a maximum amount. And again, if you look on Pension Tracker, you can see those differences. So, an employee in city X might pay 7 or 8 or 9%, and that city typically will pay 20, 30, sometimes much higher, 50, 60%. So there's this real difference in terms of the burden sharing between the employer and the employee. Some people would argue that that's okay because the employee didn't create the problem. Some people would say, well, but that is the city's or that's the employer's responsibility because they're the ones who are responsible for it. We could have a good discussion about who's really responsible for the mess that we're in. I don't know if that's productive or not, but contribution rates. So contribution amounts is just the rate times payroll. Typically people talk about covered payroll or pensionable payroll. As part of the reform in 2014, there were some items that were eliminated from pensionable payroll. And there used to be on the City of Santa Rosa website, there was a section that had, I think it was almost 80 ways that you could increase your pensionable pay, ways that you could effectively spike your pension. Uniform allowance, canine duty, you name it. There were, I believe it was 80, it might have been close to 90. It's not there anymore. So pensionable pay has been there. People have tried to reduce that down to salary only as opposed to these other equivalent compensations. Normal cost is the cost of projected benefits allocated to the current plan year. Normal cost for a lot of jurisdictions out there is about the same as the unfunded cost. The unfunded cost is simply what's required to pay for or what I have here, unfunded liability contribution. And so again, over time, the attempt is made, the objective is to essentially pay off that credit card debt. That's the analogy I'll use over some period of time, typically over about a 30-year period. Amortization period, you heard earlier that it's typically 20 or 30 years, more often 30 years, but 20 or 30 years depending on the source or the origin of it. And that's the time period over which you can pay off that debt. The ARC, which a lot of people still use in publications, is the annual required contribution. There are not agencies that I know of in California that don't pay the ARC, but there are a fair number across the country. And so they don't even pay essentially the minimum amount required to reach full funding, even under the assumptions that they use. Those are not the systems that are heading for a safe landing. I wanted to highlight, the CalPERS folks are gone here, but I wanted to highlight the little detail that they provide in their actuarial reports. I mean, they really provide a tremendous amount, which is great. And so I won't walk through each of these, but you can see normal cost, employee contribution, employer normal cost, payroll for the contribution year. They just call it payroll, not pensionable payroll. And then they've got below there the dollar amounts. And so you can have a pretty good sense of what the contributions look like, both on a percentage basis and on a dollar basis for any jurisdiction out there. And for the work that I did that I mentioned earlier, obviously we took this as a starting point and then we built a model. We went out into the future, out to the year 2030, to get a sense of what those contribution rates would be and what those contribution amounts would be as well. Unfunded liability per member, per capita, per household, pretty straightforward, just the UAAL divided by the number of members, number of persons, number of occupied housing units. That last one's a little bit funny. Those last two are on pension tracker. And so we have those in there because it's a pretty good measure, I think, or a pretty good metric to be able to say, this community has this unfunded liability per household versus some other dollar amount over here. And I think it was someone from Menlo Park who approached me, and I won't say he was excited, but he was at least happy that Menlo Park had a per household unfunded liability of about half that in Palo Alto. Maybe there's competition there, I don't know. But it was interesting that, and frankly, that's one of the reasons we put it there. We want communities to compare against each other so they have a sense of what that number is. Yeah. Can I put it in perspective? Well, I mean, you could, I would say, let's say that it's 50,000. If the unfunded liability per household is $50,000, my immediate thought was to put it in terms of of either wealth or assets or income or budget or the value of the houses or that as well, because effectively, if it's $50,000, then someone's got to pay that someday. And so the odds are that you'll pay some share of it. I mean, if in the end, if they're, assuming there's a fix, would you pay as a property owner through a property tax? Would you pay through a sales tax? Would you pay a higher income tax that would be rebated? I mean, there are lots of ways to get there, and that requires all sorts of assumptions. Yeah.
So continuing the media toolkit discussion, this is a cheat sheet that we've created, and we can provide it to anyone who wants to better understand the impact of the discount rate. So let's assume that the discount rate is 7.5% currently. Oops. Yeah. For an example plan, 7.5%. And then the duration of liabilities is 14 years, as can be observed in many CalPERS individual systems. This results in a 66.7 funded ratio, which is a ratio of MBA to AAL, as Joe has discussed. And the unfunded liability is 50, which is just a difference between those two. But let's say we change the discount rate by 0.5%. So if you look at the new discount rate scenario, number one, that 50 basis point change results in a 20% change in the unfunded liability, and then the funded ratio plummets by 5%. But then let's say we changed the discount rate further and lower it by another 2%. The unfunded liability doubles and the funded ratio falls below 50%. So what I want to emphasize here is the power of the discount rate, and that's because it is compounded by the average duration, and so the resulting liability is much bigger due to that compounding. So these are just other metrics besides the actuarial ones that Joe has talked about. These are more related to the asset portfolio. So actual rate of return is very straightforward. It's just the investment gain loss, the change of the asset prices, plus any income, so dividends plus interest. Actually, that should be interest, not income. Income includes both of them over the beginning market value. The second formula is there to highlight the difference between actuarial gain loss and actual gain loss. So the actuarial gain loss is based on the assumed rate of return, which is the discount rate. Very different from whatever you gain from the portfolio. In some cases. The compound annual growth rate is a smooth growth rate, so it kind of gives you a rough idea of how the portfolio performed on an annual basis over a longer period of time. So you take the ending MVA divided by the beginning MVA, and then you take that period of time, you raise it to the to 1 over that period of time to get the growth rate. So you would compare this compounded annual growth rate to the assumed rate of return or the discount rate to give you an idea of how the portfolio has really performed over a longer horizon versus the assumed discount rate. Then finally, the total expense ratio, I kind of showed that earlier in that bar chart of the management fees, but it's really just the total fees that are incurred for management of the portfolio plus other administrative fees over the total assets average of the current year. Then finally, the demographic ratio I have here is kind of related to the asset portfolio as well because it tells you about the plan maturity. So for a newer plan, there would be more active members and fewer retired members, and a newer plan would then be able to take on more risk and perhaps invest in more equities or alternative investments, while an older plan would focus more on income assets and probably be weighted in lower, obviously lower risk, lower return assets. The last chart, the last slide is really just about our team as a resource to use. So of course, there's the pension tracker team. That's Joe, the RAs, myself, and of course, our strong network of supporters, including Bill Sharpe and Jeremy Bulow, who've shared so much of their knowledge and time with us. And so for that, we're very grateful. And then also our super publications that we've already talked about, our policy briefs and working papers, including Jeremy Bulow's paper that's published already or about to be published very soon. And then finally, the pension tracker for both US and California. We didn't go through every single feature in pension tracker, and if you haven't seen it yet, you can download the data. You can filter it, download the data for one or many pension plans, and then we have analytics which are available all on the user interface, including all these metrics, or most of these metrics that we've gone over today. And then finally, you can graph and look at charts of a single pension plan or compare these metrics across several pension plans. So that's it.
So we have Bill here just so we can answer questions.
I have no
Right.
slides. Again, I apologize for my voice. I guess just a couple of things partly that came up. One was the issue of DB versus DC and why we seem to have DB in the public sector and DC in the private sector. Now, some of this, of course, is just history. We used to have DB in both sectors. But there's, I think, perhaps a more fundamental reason. And let me tell you a little bit about a dissertation done, one of my students many, many years ago, because it's just interesting. He managed to get hold of handwritten records of indentured servants in the colonial era who came to Philadelphia. These were meticulously recorded. It was the Philadelphia, they were basically Germans. It was called something else. But in any event, so John Doe came over, got his passage paid. In return, his servitude was auctioned off for a period up to 7 years. And he had the contracts. John Doe, the contract was, all right, you're indentured for 7 years. Every year you get a new suit. You get housed this way, you get that. And when you finish your term, you get such and so. So they were sort of like a salary and a pension. If you think about it, it's sort of the time pattern. And he did all these wonderful calculations, internal rate of return. It was a wonderful dissertation. But what I want to point out was there was a result which was really quite striking and statistically significant. The Germans, which they called Pennsylvania Dutch in that era, typically had a pattern where they got a fair amount while they were indentured and then a nice little payment when they left. But the Irish, the terms were lower payments while they were indentured and a very big payment when they, quote, retired, if you will, at the end of the period. and this was really it was statistically significant. And the reason was, for whatever reason, the Irish were more likely to run away. Now, why do I bring that up? Because I think there has been a history in public service, especially when you're thinking about police, of wanting your public servant to stay with you for a long time. It takes a long time to learn how to do certain things in public service, and also to be honest while they're there. So I think one of the reasons we've always seen a more back-loaded compensation scheme in public service than in private service is because there is this difference, not everywhere, not in every position by any means. So I think before we rush too quickly to say, well, let's just go to DC and public service and be done with this, we might need to think about that. That's one point I thought I'd make. The other, is regarding private equity and venture capital. I mean, that was a pretty profound difference in those pie charts. I hadn't seen that before. And there's a study, I forget now the authors, but it was pretty convincing. It turns out in most public programs, your discount rate, your actuarial rate, is related to and is supposed to be equal to your expected return on your assets. And it also turns out, for good or ill, it has been traditional to add another 3%, 300 basis points, for private equity, venture capital, sometimes real estate, to what you assume for equity. So if you're assuming 8% for equity, you assume 11, because there's supposed to be some magic there, or maybe it's an illiquidity premium. So if you shift assets towards private vehicles, you crank up your expected return on assets. That's the actuarial rate. That lowers your liabilities using actuarial measures. And this particular study found a fairly plausible connection between just that sort of behavior. So, and that brings me to my larger point, which has been floating around. The kinds of things that actuaries in public plans do, not in private plans, partly because they're constrained, but public sector, GASB, Government Accounting Standards Board, as opposed to FASB, Financial Accounting Standards Board, which is the private sector. Basically, they use these, we would say, too high discount rates. And that has the effect of lowering the cost of things in the near term. You don't have to put as much money in for your employees. Raising it in the long term. The roosters will come home to roost, but we'll be out of office by then. The union reps may have retired by then. So it's very, very, very tempting for elected officials in particular to do this sort of put it off till somebody's term in the future. And I think that explains a fair amount of what we're saying. So my bottom line is we really need to recognize that that market value on pension tracker is much closer to what you are really on the hook for, and that we really need to realize that we are giving benefits of a considerable value. Finally, are we paying public employees too much? My answer to that is really simple. When you post the position, see how long the line of qualified candidates is. The question is not, you see studies, well, public employees get less. No, they get more. The question is the total comp package, including the DB plan, et cetera, more generous for a given quality candidate than the private sector package? And, you know, I've said, I've asked in Carmel early on, well, you know, when we post a position, how many qualified applicants do you get? And the answer I got was not many, sometimes none. I asked Joe once, and he talked about somebody, maybe you don't want to say the public agency, but said, yeah, we posted, we got 500 people. Well, I have a feeling that if you got 500 people, your total comp is too high. But again, and this whole, I should say, as others have before me, my mother retired with checks from CalPERS. My stepfather retired from checks from CalPERS. I'm a strong advocate of public service and of paying public servants appropriately. But I think there is just something inherently dangerous in a DB plan for public service, and I'm reluctantly concluding that I'm afraid we need to go to DC. But again, we can provide annuity-type DC plans, as I mentioned earlier. So I think those are some of the big issues as we sort of step back and say, you know, if I were king and I got to design the comp package for the public sector, what would I design? And I think it would, and it might have a backloaded character too. You can easily do that. You know, we'll give you a DC plan, but, you know, if you make it through 30 years without getting caught doing something nefarious, we'll give you an extra X. So, I mean, there are ways of accomplishing that too. But I think we really need to think fundamentally about this situation. It is bad now. It is really bad now. And we need to figure out how we're going to deal with that. And then we need to figure out whether we ought to be doing something prospectively, at least for new employees. Period, end of diatribe.
Thank you. Questions? Actually, real quickly, so it was a firefighter position in San Rafael, California.
There you go.
That's what it
Well,
was.
how do we apply?
So, yes.
Yeah, I've been sitting here all day listening and wondering, gee, we have a problem, and the problem is even more complex than I thought. And we come to solutions, and we haven't heard too many solutions, except we need to pay more money into the system to get it to work better, which to me isn't really a solution. It's just giving more people more money. And yes, I do think the public employees, they may not be paid too much, but their benefits are substantially
I'm talking
higher.
about the total comp.
Okay, even the,
So that would say they're being paid too
Total.
much, if you're right.
But let me talk about Palo Alto, which I know. We have police and fire who can retire at 50. They get probably about 90% of their salary when they retire. Add to that their COLAs each year, and pretty soon they're making more money at home, retired, than they are working. They get life benefits for health, and for not only for them, but their spouse, and also all future spouses. So some of them are getting 120% of their salary. And I have to ask, why are we so generous with our employees when nobody in the private sector gets that kind of salary, that kind of pension? Okay, next point. If the employees get benefits, it doesn't only just happen in one city like Palo Alto, because employees in Menlo Park say, well, they just got more pension money than we did, or they got more vacation days, so we want it. And each city ratchets its benefits up because there's competition among the cities, and the cities only want to hire the best that they can possibly hire. So the solution to me is not more money, not necessarily getting rid of COLAs, but that would help, but somehow getting these benefit levels way down, convincing employees that they shouldn't get 90% of their salary, get 50% or whatever the normal retirement is. And, you know, I can't remember how many managers Palo Alto has, probably about 300 are making over 100,000 to 150,000 a year. I mean, the amount of money this one city is paying out is just enormous. So maybe in future years we can address this part of the problem, because the little solutions we have are not adequate to me.
I would just say, we've got to educate the voters. I mean, you know, and that's what we're trying, I would think, in large part, that's what we're trying to do. The
problem
voters
is
need
with
to
the
be
vote-
educated.
Sorry. Problem is the voters, they just glaze over. I mean, it's not a sexy topic.
I'm sorry, I missed the word.
The problem with voters is they glaze over when you start talking about pensions.
I understand.
And I love my firemen, I love my policemen, I don't want to hurt them. And it's a very, very hard sell. It's not a sexy sell.
Yeah, I couldn't agree more. And that may lead you to say, okay, whatever the benefits of a DB plan may be, we'll never get over that. We'll never educate the voters to these complex matters. Go to a DC plan. Well, you know what they're getting. I mean, you can see it month by month. And it may be an inferior plan in the larger picture, but that may be what we have to do.
Hey, Bill, I'm a retired city employee from San Francisco. One of the problems with the DC plans I found was that they're not ERISA protected. And so, I mean, they're actually,
They can be.
yeah, I mean, because they seem they're very inferior to what everybody's getting on the 401ks if you go to a DC plan. I mean, it seems like there's a lot of shenanigans going on and finagling with the DC plan. So I'm just,
Well, again, you can provide not only a tips option, let's say, in a DC plan, you can also provide an annuity option. And as I say, we're beginning to see that coming in a bit.
but can you make it like a 457 plan ERISA protect? I think by law it's not for ERISA protected. So that's all I'm
No.
saying. I mean, it seems like it's.
Well, protected against what? I mean, it's obviously,
I
I
mean,
mean,
like,
you can't protect, you probably, I don't know the.
I mean, San Francisco. You talk about Prudential, and like General Motors sold off some of their assets to Prudential, right?
They defeased, yes.
And I mean, I've been writing about in San Francisco, they take some of our money that's going to the DC plan or deferred comp and are buying derivatives with them. So it's
Well,
becoming-
but don't you have options, don't you?
no, I mean, if I say I want to go into Vanguard XYZ fund, Prudential has a right to put the money into derivatives instead as a substitute. That would not happen in a ERISA plan. I'm just saying I'm not saying it's bad to
Well, that's it. Talk to the employer, which is in this case the city.
right.
Why are you putting that squirrely plan in as an option in your DC plan?
That's the question.
Again,
It seems like as a participant, we don't have that protection. Where if it's ERISA, we'd be able to go up the chain and go, hey, this is synthetic portfolio, blah, blah, blah. With ERISA, we have to go to the city, and then you're dealing with politics. So that's,
well, in the private sector, you also have to worry about the solvency of the PBGC, Pension Benefit Guarantee Corporation. In the public sector, you've got to worry about the solvency of the state of California or of Stockton. But nobody, I mean, employees never thought about that. I mean, people who signed on to be firemen or police people or police women didn't think about, how solvent is Carmel? Well, how solvent is California? How solvent is Stockton or Vallejo or San Bernardino? They're beginning to think that now, which is really unfortunate.
I mean, they're starting to think about it in San Francisco, too. It's about
Yeah.
80% funded, so.
Yeah.
Hi. So I was wondering, early in the presentation this morning, somebody put up rates of return for the last 90 years. And I think they were nominal rates of return.
They were.
And I think I heard the professor here argue that at some point we should be using real rates of return, or at least putting an agreeing what an inflation number is going to be going forward and saying that we should have a return premium on top of that of some number. And I think if we do, and it can vary by asset class and all kinds of fun things. But in general, I think the fact that CalPERS hasn't decreased their rate when inflation has gone down, for example, in the last number of years, they haven't actually materially changed the mix of their portfolio. In other words, it hasn't gotten that much more risky. So they should have been lowering it for no other reason, just because they should be going down, much like the treasuries did with inflation. So at least our county, because we're not in CalPERS, we're in a county, we actually have an inflation assumption and a risk premium in addition to that is what their target is for a return. It seems to me that would be an interesting way to think about a lot of this and convince people possibly that they should be earning a more realistic rate of return based on the treasuries plus a risk premium based on the riskiness of their portfolio.
CalPERS does build up their expected returns, as you're suggesting, real rate, inflation, et cetera. And I haven't looked,
Not having it change.
well, I haven't looked at them recently, so I can't answer. But, yeah, I mean, to the extent you have a generous COLA, and CalPERS COLAs are, generous, they're close to 1-for-1. There's some complications, but they're not that far from it. Then real rates, and if you look at their termination fund, they do put tips in, and when they calculate what they will actually charge you if you want to terminate, they use a combination of the tips rates and the nominal treasury rates. So there's no doubt about that. They're very aware, the actuaries understand all that, and the investment people have some sort of an assumption. But again, we've seen, we couldn't see real rates 30 years ago because we didn't have treasury inflation protected securities in this country. So we couldn't see them. But We've been able to see them since the TIPS were instituted. These are, if you don't know, these are Treasury securities where what you get is basically a promised real rate net of inflation. There's some nuances, but that's the nature. So they do use that in deciding what your liability is worth when you terminate. And they do project inflation in their asset allocation assumptions, asset return assumptions. But again, as you point out, looking at the nominal rates, Treasury rates, I mean, yeah, they were very high at one point, and inflation was 12% at that point. So that's very deceptive. Sorry for those who showed those graphs. Look at those very high Treasury rates, because the real rates were not that high by a long shot.
Thanks. How do private corporate defined benefit programs compare with public, say like a teacher, in terms of percentage of employee contribution and benefits? Is there, can you give a rough?
I'm not up to date.
Yeah, I'm not, if Jay Peters, who was here earlier, is on the private sector side, he'd be able to give you a good answer. I can follow up with him and get back with you, but
There were no explicit, back in the day, which for me is a long time ago, there were no explicit employee contributions at all. This was the deal. Here's your paycheck. You just accrued this much in benefits. So they didn't even try to proportion it. But I can't speak to now.
the question, yes.
Sharon Erickson from City of San Jose. So why aren't we using the TIPS rate instead of the 20-year Treasury rate then?
Because nobody listens to economists. It's part of a broader theorem.
Okay, so if in the best of all possible worlds I was using the TIPS rate, right now it feels like we've all drunk the Kool-Aid that the actuarial discount rate should be the funding rate, should be the discount rate. What you're arguing for, as I understand it, is to separate those rates. So on the one hand, I would have the TIPS rate to come up with my liability, and then my investment strategy, and which would drive my contribution rates, would be a separate set of numbers. Am I getting that right?
Well, I'm trying to separate the issue of what your liability is from how you choose to invest. So I will speak for myself. Joe and Olympia can speak for themselves, but I would use the TIPS rate in effect to discount the future cash flows to get the liability. If you wanted to, you could invest in TIPS. Then you'd be investing sort of one for one. But if you want to, or you think your employees would want you to, or your cities, if you're CalPERS, then you can invest in something else, recognizing that you might win, you might lose. It's what we all do. I mean, we've got money to invest. We could invest in TIPS. We would then know what our real return was going to be. Or we could choose to invest in something else, and we really wouldn't know what it's going to be. There's a probability distribution. And yes, the mean of that distribution is probably higher than the TIPS rate. Better be. But it's got a spread. And it's a trade-off investors make every day, and the market sort of adjusts accordingly. I'm sorry.
I was just, one of the things that I learned from you early on was when you said that the difference is this ex post ex ante world, right? Or where in the private sector, you discount your liabilities, you choose whatever investment strategy and assets that you choose, and then you hopefully do well. And you take those earnings and you can change benefits going forward and but it's after the fact. I mean, you've gone to market, you've been successful, and then you've moved on from there. In the public sector world, it's exactly the opposite. It's this system where you say, well, we're going to guarantee the following benefits, and we're going to hope that we do really well, but we don't know if we're going to do that well. We're going to gamble, in effect. So that to me suggests that, I mean, there's just this, there's this very different approach. One where you go out and you discount those liabilities and build an investment portfolio, and the other one and then you offer the benefits or modify the benefits. The other ones you start off with the benefits. That's the first thing in that chain. And I think that's a big part of the problem, where you effectively you're constantly chasing that return. And so one of the reasons that CalPERS doesn't reduce their discount rates isn't just because of the pain that local governments will feel, but they don't discount that because because it'll make it that much harder for them to maintain the payouts, the benefits, et cetera. And until that is reconciled or changed to look more like the private sector side, I don't know if we'll solve this either. I don't know.
Well, let me just, again, yet another analogy. You have basically issued a tips to your employee, you the employer. You said, look, I'm going to pay you this much cash, the rest I'll give you this inflation-protected security. It's called a retirement. Yeah, it's dependent on longevity as well, but that basically you've done that. And you've said, thank you, employee, you've paid me for this tips. I'm going to take the money and I'm going to invest it in the stock market or in alternatives or something. And that may or may not be a good idea, but we're just saying that's what you've done. You've issued a tips as compensation to your employee. And you need to understand that's what you've done and value that obligation, that liability accordingly. Sorry, there was another.
Again, from San Jose, Professor, the thing we run into when we do that is it's not just the economic noise. It's not just the economic variability. There's a huge component of demographic variability. So even if we were to issue those tips to somebody, I'm issuing it to him at some statistical age, 85. If he lives to 93, the tips will run out if he dies sooner. So we're always stuck, right, with this problem of aggregating statistics and populations. At San Jose, when you talk about the spread, what we're trying to do is figure out, okay, we're going to get some spread of outcomes, and some of those will be very negative to the city, and there's some acceptable level of pain. Sharon is actually, we're going to talk about this there. So how do we deal with this noise? It's not just economic noise, it's demographic noise. I mean, doesn't that indicate we have to play some portfolio gambling thing?
Well, yeah, we haven't really talked about that today. You're right, you're not issuing tips, you're issuing life insurance or annuity policies. And so you have the actuarial risk. It's not bad if you live too long, but if half of you live too long, we're in trouble. And so that's another component of this. And again, that also goes away in a DC. We'll give you the money, you can invest it, and if you live too long, too bad, it's your problem. Although, again, that also speaks for maybe including annuities in a DC plan. But there's definitely that, and that risk can be handled by an insurance company. But if there's a cure for cancer, all those annuity policies are in jeopardy. So we haven't talked about that at all today. That's a big issue, to be sure. So it's that's a good thing to end on. Guess what? It's even worse than we've told you.
What we can, if there's one more, we can do one more. Otherwise that's the last word. Any other questions or comments from anyone? Oh, yes, last one.
It's even worse than that, following up on that. It's discussed as if we have to give people annuities at retiree age, but in the pension plan, what you actually have to do is you have to forecast during their working life what their final salary is going to be, and you have to accumulate along the way based on that projection. And what I've looked at, that's been the main source discrepancy for the mismatch, is that it's incredibly sensitive to the final salary and to the assumptions that you make along the way about how much they're going to earn.
Absolutely true.
It's a very difficult problem to solve in the way that people would like to solve it, is if you have some fixed contribution rate during the working life.
And again, that may be because you want to reward longevity. So you say, well, if your 64th year, your total comp is going to be huge, because you're going to get not only the salary, and not only the annuity for that year, you also get an increment to the annuity values for all your prior years of service. So it's really back-end loaded. And there's a real question, do we really want it to be that way? I got to go.
Okay.
And
Thank you. Thanks, everyone. Appreciate it. So the last thing I'll say is that, so again, we broadcast this and we recorded this. You can, if you go to the CPER website, I'm not sure how soon it will be posted, but you'll be able to view this again if you really want to see it again, or if you've got a friend out there who wants to see this. We've also got, I mentioned the publications, the Jeremy Bulow publication that's actually up on the CPER website. And then the publication that I have on the crowd out, which should be out the end of this week, beginning of next week, that'll also be on the CPER website. If all else fails, send an email to me, joenation, all one word, @stanford.edu, and I will get back with you. Thanks again for being here. Appreciate it. Thank you.